capital gains tax free being classed as legal tender, and gold bullion, so gold bricks or gold bars or any sort of gold bar from a 5 gram all the way to 100 gram to a kilogram, they are all taxable assets, right? If you was to sell them on. So what exactly is capital gains tax, and how is it different from income tax, for example?
This is a really good question and quite current, because I don't know if you follow Gary Stevenson.
No.
So Gary Stevenson is a economist who used to be a trader at Citibank.
Okay.
And he wrote a book called Trading Games. And in the last few years, he's become a bit of a economic commentator.
Yeah.
But essentially is also a political activist for reform on tax.
Okay.
His main thing is he wants to tax the wealthiest people. And he wants to tax their wealth, not their earnings. His thing is tax assets, not work. And that leads nicely onto a question of, well, what's the difference between capital gains tax and income tax? And it's effectively those two things. So capital gains tax is a tax on assets. So an asset could be a second property. It could be stocks and shares. It could be commodities. It could be, anything which has grown in value or decreased in value. So capital gains can be offset by capital losses. And essentially you pay a tax on the difference of your purchase price and your sale price. So it's most prevalent in stocks and property. It's when I come into contact with it most.
Yes.
So quite often whenever we're doing any work around restructuring of investments, for example, we're often having to sell some investments to reinvest elsewhere. Now, if we're selling investments from an investment account which is not an ISA or a pension where capital gains is exempt, then we're likely to be realizing gains. So we have to do a calculation to make sure that what we're realizing doesn't trigger a tax liability. Now, the exemption for capital gains before tax is due has dramatically decreased in the last few years. You used to be able to have over £12,000 worth of gains before any tax would be due. That's now down to £3,000. So anybody with stocks that they're going to sell or a property they're going to sell, they're likely to get trapped by that, even if you've only held that asset for a short period of time.
Yeah.
So let's just take a really quick example of, let's say, a second property. Now, your main residence is exempt from capital gains tax. So when you buy and sell your own home and you move home, you don't pay capital gains tax. But if you owned another property and you bought it back in 2020, let's say, for £200,000 and you sell it for £250,000, there's a gain there of £50,000.
Right.
So that gain is added on to your income, but taxed at a different rate to your income tax. So there's two rates of tax with capital gains tax. If you're a basic rate taxpayer, it's 18%. And if you're higher or additional rate taxpayer, it's 24%. That's changed a little bit. It used to be 10 and 20, and property used to be taxed a little bit differently at 18 and 24. Now all assets are taxed at 18% and 24%. This is one of those things that governments change quite often.
So the first £3,000 is tax exempt.
Yes.
So the following £47,000 you've earned from that will now be, for an average person like me, subject to 18% capital gains tax.
Yes, but the gain is stacked on top of your income. So if there's a really large gain, it's likely some of that will be tipping into the higher rate tax bracket as well. So you might pay 18% on some of it and 24% on some of it.
Okay, because of that's added to my actual income that
Yeah.
So what is the threshold?
£50,270 of total income. So you have your first 12,570, which is your personal allowance. Then from that amount up to 50,270, so it's £37,700, is taxed at 20%. And then from the 50,270 up to just over £125,000 is at 40%. Bear in mind, there is a stealth tax trap from £100,000 to that £125,000, where you lose your personal allowance. So for every £2 that you earn over £100,000, you lose £1 of your personal allowance. So you're not paying 20% of that personal allowance, but actually if you're losing that gradually on what you earn above £100,000, you're going to add that 20% back on top of your 40%. So it's an effective rate of 60%. Or 62% if it's earned income, because you've got national insurance contributions as well.
When you're making that much, maxing out your pension contributions and stuff like that.
100%, because if you do that, then you bring that back down and you start to reclaim your personal allowance as well. But yeah, there's many tax traps to be wary of once you start earning that level of income, which is obviously it's a great thing if you can earn that much money, but you do start to get stung quite significantly on the tax, which can be avoidable through some good planning. It's not avoidance in any way at all, but it's just smart tax planning.
Smart money, basically.
Yeah.
Financial planners, accountants, tax advisors can help you in situations.
Absolutely.
Like that,
Yeah.
So, say for instance, I earn £52,000 a year, £1,000 a week. Let's say, so £52,000 a year, but say that is before tax.
Uh-huh.
So after tax, let's just say 20% is taken off. Is that my salary that's calculated with my capital gains tax? So say I earn 50,000 from selling a property that year as well.
Yeah.
So before tax, I've earned 102,000 altogether. The tax that is on top of my capital gain, for my capital gains tax, is that without my income tax taken away from my general income, or
no? So your income tax, so the tax calculation is stacked.
Okay.
And firstly, your income tax is taken into account. Your gains are placed on top of that.
Okay.
So if you have earned income of £52,000, you're already classed as a high rate taxpayer. So your gain will sit
Even
above
before
that.
Tax. So,
Yeah. So if that's your gross income,
okay.
Even if you pay your tax and your total net income brings you underneath 50,000, it's classed on your gross income.
Okay.
So if you earn 52,000, regardless of what tax you've paid,
Yeah.
that's how much earned income you've had gross. So your capital gains tax is that on top of that. All of that is going to be taxed at 24%.
Okay. Yeah, life will get hard soon.
Yeah. So that's capital gains tax. You have your exemption. You pay your tax rate. Now, a bit different with property, because you've got this one large asset. You can't split into different parts, and you can't chop that up. But for someone with a stocks and shares portfolio, and you can sell units of stock, or you can sell certain stock and hold some stock back, you can be really clever. So one thing we do, or we work with investment managers that do as well, is we can be really efficient in how we sell down assets.
Right.
So you can sell assets that have a loss to offset against gains. Okay. So that's one way that you can help control an out of control realized gain.